Hello, chart watchers, and welcome to this Wednesday, May 9th Market Watchers live show with your hosts, Tom Bowley and Aaron Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, as we take a look at the market action today, kind of flat. We do see the Dow Jones Industrial Average up 16 points, the S&P up 8, NASDAQ up 16, the Russell 2000 hanging near the flat line, as you can see, trying to get above a couple of months of resistance just above the 1580, actually closer to maybe 1590 level. 10-year Treasury yield moving higher again today, up to 3%. So it is up 3 basis points, not far off the high we saw toward the end of April, and not too far from the highs that we saw roughly 3-4 years ago. Volatility index dropping. This is a very good thing for the bull market to continue. When you look back the last two bear markets, the volatility index never went back below 16. It is at 1406 now, down almost 4.5% today. Energy moving higher. Crude oil prices were surging today. Energy is moving in lockstep to the upside, breaking out to new fresh highs. The consumer discretionary group actually is lagging a bit in a couple of areas that I thought were interesting here. You can see toys on the one hand making a breakout to about 8-week highs. But you look at the home construction group and the higher interest rates spooking folks in home construction. We are moving now near a couple of month low in the home construction index. Internet stocks making a nice move today, breaking out above recent highs, looking to strengthen there. And railroads. So railroads are a good proxy what's going on here in the U.S. and North America in general. And here you've got railroads making another breakout. I find this to be bullish as well. With that, let me bring in my co-host, Aaron. How are you doing this morning, Aaron? I'm not hearing you. Might be on mute.
I'm doing just great. How are you doing today?
I am doing great. Of course, this is 2 days after the Caps win. So we're on to the next round, semifinals. We'll see what happens there. But I'm going to be in a good mood at least until they play next, which isn't until Friday night. So
I'm sure it'll be great. I'm sure they're going to do well. Conference finals, they got it. They got this made.
We shall see. We have a special guest with us today, Jeffrey Saut from Raymond James. He's going to be presenting in just a bit. How are you doing today, Jeff?
I'm doing just fine.
That is awesome. It is nice to have you on the show. I know that you do a lot. You've been in the market for many, many years, and I think you'll have a very interesting take on what's taking place. I know our viewers can't wait to hear from you, so we're going to get back to you in about 15 minutes or so, if that's okay.
Sure.
All right. Aaron, I know we got a busy schedule. I think we probably ought to just hop right into it if you've got the weekly announcements and the.
Oh, absolutely. Let's get this party started, as they say. So for this week, we've got, of course, jam-packed week, as we always do. We're going to have tomorrow, we have Dan Russo from Chaikin Analytics. That'll be an interesting discussion. Of course, Friday, we have everything stock charts, so you'll learn something new about the website. And then on Tuesday of next week, I'm going to be doing a workshop. I'm not sure what I'm going to do it on. So if you have some interesting topics, go ahead and put those in the survey that you can find right under the viewer on Stock Charts TV. And for today's agenda, as we introduced him earlier, Jeff Saut is here from Raymond James. Can't wait to see that presentation. And then we have the 10 and 10 to 1. And our first stock symbol is going to be Wells Fargo, WFC. And finally, we're going to end the program with technical scans and show you how to do some scanning and what's coming up on some of our scans. And with that, Tom, I'm going to turn it back to you for some headlines and news.
Sounds good. Well, we always like to start with that 10-year Treasury yield. You can see it is up near 3%, very close to the high that we saw back at the end of February. We got up to about 3.04%. And of course, if we go back, take a longer look at the 10-year Treasury yield and go back 15 years on a monthly chart, you can see it was the end of 2013, early 2014 that we went just above this 3 level. And if you use this inspector button here, you can see that we got up to about 304 in December of 2013 and the high 303 in January of 2014. So that's really what we're trying to get through. In April, we saw the high go up right to that level, 3.035. And we're making another move here in the short term, heading a little bit higher on this daily chart, which I will bring back up for you. So you can see a nice move to the upside, perhaps a little cup here forming. I think eventually we're going to break through. The Fed's been telling us more hikes are coming down the road. Economic activity seems to be picking up. And so I look for higher rates here in the U.S., and I think that's bullish for the market, but that's just my opinion. Now, let's take a look at some of the things going on in terms of economic news today. We had the April PPI out this morning at 8:30. It showed that the producer prices had increased 0.1%. The market was expecting 0.3%. The core PPI was as expected at a rise of 0.2%. And at 10 a.m., March wholesale trade came in, rose 0.3% versus the anticipated 0.5% increase. And I think overall, the economic news pretty solid, not really much inflation, and the Treasury yield moving up with folks just kind of bailing a little bit out of the bond market. Now, what I wanted to go over today, and just as a summary of some of the things that I'm looking at, some of this is a refresher for many of you. Those who are new might find this pretty interesting. I think this is a really important chart as we go forward in how you trade the stock market, because I mentioned this back when the dollar was at about $88 or $89 earlier in 2018, and while we were in this downtrend, I pointed out that if we compare the U.S. Treasury yields to Germany's Treasury yields, the 10-year Treasury yield in both countries, that normally, as you see this change, when we move up, when U.S. rates are moving higher faster, that normally triggers a response in the dollar to the upside. So we normally have pretty strong correlation. That's what this down here shows. It's telling us that if we look at the 10-year Treasury yield and subtract the German 10-year Treasury yield and compare that to the dollar, we have a pretty strong positive correlation where it stays above zero most of the time. But we did have a few periods back in 2009, again in the middle of 2013, and then again just recently, where the yields in the U.S. were rising faster than Germany, but the dollar actually was going the other direction. And that doesn't happen very often. But in each of those cases, it resulted in a negative or an inverse correlation printing. And in both of the prior times that we saw this occur, these negative divergences where U.S. rates were rising faster than Germany and the dollar was moving down, the dollar made a quick, rapid recovery to the upside to play catch up. We saw it back in 2010. We saw it again in 2014. And as a result, we've been talking about, Aaron and I both have been talking about the fact that we've been bullish the dollar even while it was downtrending. And now we're starting to see what I think is a very significant breakout in the dollar to the upside. And so check out what's going on right now in the rates here in the U.S. versus Germany. It is still pointing up, and we got a lot of catching up to do here. So I think the dollar is in the midst of a major move to the upside. And the reason that matters is if you're managing your portfolio, I think one of the things you have to consider when you get into something like this is that when the dollar is making a big move to the upside, as it did back in 2014 and in 2009 into 2010, small caps tend to outperform the benchmark S&P 500 by a wide margin, and we're starting to see that again here in 2018. The reason? Well, when you've got the dollar moving higher, a lot of those multinational companies on the S&P 500, they do a lot of their business overseas. Those profits have to be translated back into dollars, and the rising dollar takes a hit on those companies' earnings. Small caps don't have to worry about that. So you start seeing money rotate with a rising dollar, especially a rapidly rising dollar. Money rotates into small cap stocks. And I think right here, this is a pretty good demonstration of exactly how this is working. We got the dollar starting to move up and the Russell 2000 breaking out on a relative basis. I think that's really important as we go forward. A couple of other charts I want to pull up because long term, I look at the S&P 500. First of all, this is a chart where we topped back in January. So this is a daily chart. And I wanted to point out the volatility index because the volatility index shot up. We got up as high as 36. We came all the way back down to about 15, shot back up. Now, this was as of April 11th. So this was a chart that was about a month ago. I'm going to update this for you in just a second. Actually, let's go ahead and update it now because really the VIX is what I want to show you. So let's go ahead and change this to 5.9. Update, and now take a look at what the VIX is doing. So the VIX, while it shot up in early February, and we've had a couple other spikes, We are now down to 14. And the reason I bring this up is that in the last two bear markets, the volatility index never went below 16. So you need a certain environment for a bear market to thrive. When we start getting these spikes, the problem is as we work our way back down in volatility, when we go below certain levels, it's telling us that fear is coming out of the market. The market's becoming more complacent, and when that happens, the market tends to overlook bad news and keep chugging higher. Now, we haven't seen a breakout yet in the S&P 500, and I think part of that is because we're seeing money rotate out of the S&P 500. Let me bring up one other chart here on the S&P 500, and this is going to show you the long-term channel that we've been in. If you connect the highs going back since the low in 2009, the reaction highs, connect those, connect the lows, you have parallel lines. This is a channel. We saw this channel back in the last bull market, 2003 to 2007. And when that broke, we had to be careful. Well, we're still in it. So as far as I'm concerned, the bull market lives on. The volatility dropping is adding to it. And if we look at, say, consumer discretionary versus consumer staples, we have gotten a huge breakout. And I know some of you have said, well, you know, XLY is heavily weighted by Amazon. Well, I've looked at the non-weighted index for both the consumer discretionary and consumer staples, and that is rising as well. Those two ETFs are rising as well. So they haven't broken out the new highs, but they are on the move higher, and that's telling us that on this in these last few months, money continues to rotate into aggressive areas of the market. And that's important because that does not happen in a bear market. In a bear market, you see the exact opposite. Also, transports versus utilities. We've seen a little bit of a pullback here in 2018, but we did break out earlier to new highs. And with railroads, I showed you earlier in the program, getting close to a breakout. I think this is something we want to keep a real close eye on. I think transports are about set to make another push to the upside against utilities. Banks versus the REITs. Banks are the more aggressive part of financials. The REITs are the more defensive area within that financial space. We are seeing a rise here. More money is flowing toward banks on a relative basis, which I like. Also, with the 10-year Treasury yield potentially breaking out again, from my background as CPA auditing banks, I can tell you that higher Treasury yields result in higher bank profits. And I think that this is what this chart is telling us. Since we bottomed in the 10-year Treasury yield and we've started moving up, banks relative to the REITs are making a big move. Russell 2000, we talked about this earlier. I always find it good when you see small caps moving up versus its larger cap counterparts found on the S&P 500. So I think this is good. You might say, well, why then, 2014, 2015, and so forth, even 2017, we had a declining ratio. Why wasn't that bad for the stock market? Well, number one, it's only one signal. And number two, we had a very bearish dollar. And when the dollar is declining, that's going to benefit the S&P 500. So there's an element of aggressiveness when money flows into the Russell 2000, but there's also an element of just which index simply makes more sense. And when you've got a period of declining dollar, when the dollar is moving lower, that's going to benefit those S&P 500 companies, and it won't have that same benefit for the Russell 2000. A couple other charts here. Let's take a look at the small cap index. This is the S&P 600 small cap index. Doesn't look like a bear market here. I see equal highs coming across, rising lows off of an uptrend. That's an ascending triangle. I expect to see a breakout here above that 985 level. And when we get it, that's a pretty substantial measurement. When you look down at 890 to 985, that's almost 100 points. That's over a 10% move that I would expect to the upside in the S&P 600 small cap index. And I think that is going to coincide with that continuing rise in the dollar. Maybe one or two other quick charts. Now, with a rising dollar, I know Aaron's mentioned this many times. Of course, you get the inverse relationship with gold. When the dollar goes up, gold struggles. Well, if we take a longer term weekly look at the GDX, which is the gold miners ETF, and compare that to the S&P 500, this has not been a good place to park your money since 2011. And with a rising dollar, I don't think it's going to be a good place to park your money anytime soon. If you look at just gold itself relative to the S&P 500, same thing. If the dollar is strengthening, keep in mind 2017, the dollar went down about 14%, and gold relative to the S&P couldn't catch a bid. Now that the dollar is rising, I find it very difficult to believe that gold is going to be a good investment relative to the benchmark S&P 500. And then let's take a look at I think maybe one more chart here. This is the S&P 500, and goes back the last 15 years. So it's a 15-year weekly chart. And you can see the bull market that began back in early 2009 continues on. Anytime you have selling, I can understand the fear that's out there. But we saw sideways consolidation for a period in 2015, 2016, and then broke out. I think this is simply just a little bit more of a reversion to the mean after a huge move up at the end of 2017 into early 2018. And so I think the market, the S&P, needed this consolidation. And again, with the rising dollar, the S&P is going to struggle a little bit more on a relative basis. What I like about this chart, here are the sectors relative to the S&P 500. Technology, the XLK, relative to the S&P, continuing to print new highs. Consumer discretionary or cyclicals, relative to the S&P, breaking to new highs. Industrials have been consolidating here in the first few months, but I think some of the things I pointed out earlier, railroads potentially trying to break out. I think we're going to start to see some, and we have actually in the last week or so started to see relative strength in the industrials. And then we come down the financials. Financials have pulled back, but with rising treasury yields, I think the banks are going to lead that higher. I think we'll start to see more relative strength. Now, if you're going into a bear market, what you would expect is money starting to rotate into defense. Well, look at consumer staples. To me, this is the biggest defensive area, one of the areas that I like to concentrate on when we talk defense. And XLP relative to the S&P has been going down for more than 2 years, and it is still falling. This is not a good sign for those expecting a bear market, in my opinion, because money's not rotating in that manner. The XLU, we saw a little bit of bounce earlier this year, but other than that, we have been in a steady decline here for a couple of years. And even the healthcare group, which I think the healthcare, there are certain areas of healthcare that can still be considered aggressive, especially in the biotech area. But still, this is one of those quote unquote defensive sectors, and the XLV relative to the benchmark S&P 500 also moving lower. One final chart I did want to show you was the VIXN, the VXN. This is the volatility index for the NASDAQ 100. We've talked about this a lot, but when you get these spikes up above 30 on the VXN, notice how they in every case, they have marked significant bottoms in this continuing bull market on the NASDAQ 100. We've seen twice spikes up to that 30 area, even moving up into the 30s. And both times you can see very significant bottoms put in on the NDX. Now we're trending lower. I expect we'll be breaking out on the NASDAQ 100 sooner rather than later. And with that, I'd like to bring in our special guest, Jeffrey Saut. He is the Chief Investment Strategist at Raymond James. Been in the business a long time. This has been a crazy market the last 3 months, Jeff. What are you seeing? I mean, what do you think?
I'm in your camp. I think we're in a secular bull market. I think it has years left to run. The typical secular bull markets last 14 to 18 years, depending on where you want to start your count from. Most people say March of 09. So we're 9 years into this thing. You ought to at least have another 5, 6, 7 years left. In my first chart, if you're able to pull that up.
Yeah, you'll need to share your screen, I think, and then pull that slide up.
I don't know how to share my screen.
Oh, it's that
that big button.
It's that green button on your screen at the bottom.
Or there should be a big one in the middle.
Yeah, the bottom middle, there's a green share screen button.
Yeah, I see it. I see it. Yep. There you go.
Here we go.
Can you see it?
Yep, just start that show, yeah.
So those green areas are secular bull markets. The one on the left is 1949 to 1966. And then you go sideways. Now, if your definition of a bull market is up 20% and the bear market's down 20%, that 1966 to 82 range-bound market had 9 bull and bear markets. But to me, secular bull market is different than 20% up or 20% down. You know, are there pullbacks? Yes. In the 49 to 66 secular bull market, you have the Jack Kennedy steel crisis, where the steel companies raised prices by 5%, and President Kennedy said, no, you got to put them back down. And the market didn't like that, and they got hit for about 28% in a very short period of time. In the 82 to 2000 secular bull market, you had the 87 crash. But if you look at the chart, it did not stop the secular bull market. And then we peak in March of 2000, and we basically go sideways for 13 years until you break out in the March, April of 2013 timeframe. So there's your time range between 1966 and 82, and it shows the 20% plus ups and downs. Now, we were range bound from 2000 to 2013, just like we were between 1966 and 1982. And here's where we broke out in 2013, confirming that the secular bull market was alive and well. That is what a secular bull market looks like. That's the 82 to 2000, up 1,180%. Now, one of the things that is kind of an indicator I've used, and there's not a lot of people left, in my opinion, interpret Dow theory right, but it's not always right, but it's right a lot more than it's wrong, and it's subject to interpretation. There was a Dow theory sell signal on September 23rd of 1999. Raymond James is the only people that wrote about it because I wrote about it. There was a buy signal in June of 03. Here's the killer Dow theory sell signal on November 21st of 07. And then you went into the bottoming process. And I think the bottoming process actually started in October of 08. In October of 08, it was actually October 10th of 08, 92.6% of all the stocks traded made new annual lows. I have never seen that kind of action. That is a 7 or 8 standard deviation event. It is not supposed to happen in your lifetime. And I am in print saying the bottoming process has started. And then on March 2nd, Barton Biggs, God rest his soul, and I were on CNBC and Bloomberg together, and we both said we think the market bottoms this week, and we have been running with the bulls ever since. Have we tried to call some pullbacks now and again? Yes, we have. You'll see a lot of people say this is the second longest secular bull market in the market's history, but they cut off the 82 to 2000 secular bull market in 87 because of the crash. But as you see, if you recall the long-term chart, that did not stop the secular bull market. They cut off the 1949 to 1966 bull market in 1956 because Egypt tried to take over the Suez Canal and the market took a 30% hit. It didn't like it, but it didn't stop the bull market. Now, a lot of people say you forget about having an MBA or a CPA. In investing, you do better with a degree in psychology because most people buy up in the excitement, thrill, euphoria, and then the market rolls over. And because they don't manage risk, and managing risk is really the key to the successful investor, because they don't manage the risk, they sell in the capitulation, despondency, depression area. And that's really the psychology of the equity markets. Some people have talked about this. The number of publicly traded companies has actually just about been cut in half. So if demand picks up, there's not as many companies out there to invest in. We had a 35-year bear market in fixed income, and then we had a 35-year bull market. I'm with you, Tom. I think that interest rates are going up. I think they're going to go up glacially, but I think they're going to go up. And here's proof positive. We come in with tall Paul, and interest rates peaks and starts down. Then you get a shorter Alan Greenspan, and a shorter yet Ben Bernanke, and then Janet Yellen, and rates bottom. And now we got Jerome Powell. It's kind of like that movie Caddyshack when Judge Smale says, "What'd you shoot today, Ty?" And Ty says, "Oh, Judge, I don't keep score." And the judge says, "Then how do you measure yourself against other golfers?" And Ty says, "By height." So we think the secular bull market and fixed income's over. The economic backdrop, we've had kind of a slowdown scare here. We think it's going to reaccelerate. I still think the economy is very strong. You see NFIB Small Business Optimism Index at the highest level since the third quarter of 1983. Earnings improvement before the corporate tax rate cut came. S&P's estimate for the S&P 500 this year was around 141, 142 bucks. It's up to a little over 158, and next year's estimate is pushing 174. The participation remains robust. The AD line still looks pretty good to us. We favor active over passive. When this ratio chart, when it's up near the top of the chart, active managers have been outperforming indexers, if you will. Down where the arrows are, it's always been an inflection point. There's always room in a portfolio for indexing or passive investing, but there are times you want to overweight it, and there's times you want to push money back towards active managers, and we think that time has arrived. Speaking to valuations, are stocks cheap, fair, expensive? Well, if you use 158, around 26.90, we're at 17 times. That doesn't sound that expensive to me. Back in March of 2000, the median PE was 31 times, and the median PE in March of 2018 is 17.3. There are more high growth companies and high margin companies in the S&P than ever before, so higher valuations than the historic norm makes sense to me. There's also been this tectonic shift from tangible assets on balance sheets to intangible. So what's an intangible? Well, Facebook has got 2 billion embedded users. What's it worth? It's worth a lot, but they can't carry it on their balance sheet as an asset. So, intangible assets should, by definition, have higher than historic norm valuations. If you take out, you'll hear all different numbers from different people. What's the average PE since 1926? I hear 15.5, 16, 16.5. But if you take out the aberrational low PEs created by double-digit interest rates and double-digit inflation in the 70s and 80s, and start on January 2nd of 1990 and get the S&P's price-earnings ratio, January 2nd of 91, 92, 93 through January 2nd of this year, the average PE has been 23.85. So that kind of gives you a measurement. By the way, PE ratios have not been a real good determiner of market direction. The red or orange, whatever color they are, bars are PEs, and the green thing is the S&P. So even high PEs, the S&P went up, and you can see it came down with low PEs. Historic valuation measurements may not be as applicable right now as they are, because the way the tax code is written, companies are going to be accelerating their depreciation and amortization as quickly as possible. To me, that fundamentally shifts the argument about PE valuations of the market, because if companies are intentionally accelerating the depreciation of non-cash items, historic valuations likely go right out the window. We think you've transitioned from an interest rate-driven secular bull market to an earnings-driven secular bull market. The average return at the bottom right corner of that column is 13.1%. Per year since 1938. Here's your flip to a earnings-driven secular bull market. These are the mindsets that investors go through in the market cycle. We're certainly nowhere near enthusiasm, exuberance, or unreality. We think you're at guarded optimism. What's driving this thing? The same forces I've been talking about since '09. Soaring levels of creativity, massive new energy reserves, gigantic amounts of capital, and unrivaled manufacturing depth. Investment themes. I agree with your dollar breaking out here, but I will tell you this is another ratio chart comparing commodities to stocks. Commodities relative to stocks are the cheapest they've been since the 1960s. Down back in here. So we have been tilting portfolios towards some tangible assets, things like midstream MLPs, soybean producers, stuff like that. Energy is a disconnect for us too. The energy valuation levels for the energy companies are trading basically at the same valuation levels they were when crude oil was $26 a barrel, and as you pointed out, Tom, it's over 70. So that's a disconnect. Increase in CapEx, you're going to see that because companies can now expense capital equipment in a year rather than depreciating it over 6 or 7 years. You're going to see increased mergers and acquisitions. Lord, no, we've seen a bunch of that this year. E-commerce, don't have to really explain that. The Amazons of the world are winning, and the Gander Mountains are going bankrupt. Tech revolution, don't ask me about Bitcoin. Peter Lynch taught me not to invest in things I don't understand, and I don't understand Bitcoin. But I think blockchain is for real. I think artificial intelligence, cybersecurity, robotics, financial technology, I think those are all investable themes. The long slide of the dollar, when the Fed was created in 1913, if you measure as of 2013, measured in 1913 dollars, it's worth about 5 cents. And I should update this chart because it's only worth about 2 cents measured in $1913. What's going to kill the bull market? Global growth would have to decelerate. It's not. Wages and inflation would have to surge. They are not. The Fed would have to tighten monetary policy significantly. It's not happening, folks. The ECB would have to tighten policy substantially. That's not happening. Credit growth would have to be surging. It's not. Corporate animal spirits would have to be taking off. They are not. Equities would have to be expensive relative to bonds. That they are not as well. And investors would have to be euphoric around equities. And that's just not happening. So we continue to think you're not seeing the classic signs of excess that would have to be evident, and they're just not there. And I would also point out that there's not a whole lot of us left around that have seen a secular bull market, either in 1949 to 1966 or in 1982 to 2000. So I will leave you with this thought. My dad made me read The Intelligent Investor when I was 13, and I probably read it, I don't know, a dozen times since then, and I always seem to get something out of it. And the central theme is about managing risk. And it's captured in this quote by Dr. Benjamin Graham when he says, the essence of portfolio management is the management of risks, not the management of returns. And he closes that thought by saying all good portfolio management begins and ends with this premise. My father used to put it much more succinctly. He said, son, if you manage the downside in a portfolio and can eliminate the big losses, the upside's going to take care of itself. But it is the hardest thing to get investors, especially individual investors, to do. You know, it'll come back. It'll come back. Well, Enron didn't come back. Eastman Kodak didn't come back. So if I had one message to tell new investors, it is to manage risk and try and avoid the big loss. And with that, Tom, I'll turn the call back over to you.
Okay. Wow. You went through a ton in a very quick period, which is awesome. You did cover a lot of information, which we really appreciate. I don't know. And is there anything in the chat room? Aaron, any questions?
Oh, absolutely. Well, one of them, and I have to say it was one of my questions as well. What are corporate animal spirits exactly?
Well, you can think of Enron and acquisitions at the top. You saw stadiums being named after companies that went bankrupt. MCIC, one of the early alternatives to AT&T. And animal spirits are just not there, and individual investor spirits are damped down as well. I mean, if you recall, in 1998 and 1999, you had people leaving their jobs to day trade. We're nowhere near that.
Yeah, that's a good point.
Wait a minute, I'm day trading. Something's going on here. I'm kidding. Yeah, I've got questions, but I'm going to let you go through our listeners' questions first.
Yeah. Okay. So let's see. Rising interest rates, mortgages, cost of capital, higher fuel costs, lack of wage growth, peak earnings. What factors lead to a continued bull market?
Well, I don't think you're at peak earnings. I hear that institutionally. I was in New York last week seeing portfolio managers and doing media, and I just don't think we're at peak earnings. I think margins at the corporate level are still going to stay wider than most people expect. I do think interest rates are going up, but I think they're going up at a glacial pace, and I don't think that's going to derail anything. I don't know how it is in Charlotte, Tom, but I can tell you down here in the Tampa-St. Pete area, real estate's on fire again. Yeah, the houses are turning over very quickly.
Yep, we got the same thing in this market. I've talked to many agents actually because I was kind of looking around, and they're saying the same thing. They can't keep the supply. As soon as the house goes on the market, it gets sold.
Yeah, yep, we're not quite there. We're not quite there in Southern California, but I think that's property taxes actually have a lot to do with that one. I don't know. Let's see, what else do we have? Somebody said, that, they agree that we're in this secular bull market, but they want to know, couldn't we be in the beginning of a cyclical bear within the secular bull? I mean, I guess sort of when you were showing those areas of consolidation, there were a couple of pretty strong, I would look at them as corrections more than bear markets, but.
Yeah, but secular bull markets tend to have three legs three legs to them. I think the first leg started in October of 2008, and I think it ended in May of 2015. And then we went into that upside consolidation, and the bears came out of the woodwork and told everybody, big rounded top in the charts, the market's going to crash, the country's going into a recession, earnings are never going to recover. And then I think the second leg started in February of 2016 when Royal Bank of Scotland told investors to sell everything but high-quality bonds. Now, how long the second leg lasts is unknowable. But in the second leg is when the economy and GDP pick up and earnings growth picks up. And when the second leg ends, you'll go into another consolidation, an upside consolidation like you did between May of 2015 and February of 2016. And then you should, if past is prelude, break out of that upside consolidation and start the third leg or the speculative leg. For size, the 82 to 2000 secular bull market, the third leg began in late 1994 and ended in March of 2000.
All right. Definitely, a lot of people are interested in getting your slides because you did go through them rather quickly. Will you be? I can print them up in our blog. Do you think you'd be able to get some of those to me?
I think our legal and compliance department would tell you no.
Okay. All righty. So let's see. What else? Okay, we're talking about managing the risk. So do you use stop losses or trade the ETFs, just asset movement?
Well, we wrote, I have a long-term proprietary model that flipped positive in 08 and in October of 08 and has never flipped negative. The intermediate and short-term prop models flip more often than that. And after being very constructive through all of 2017, they counseled for caution all through the month of January. And I'm in print and I'm on TV saying our short and intermediate term model are saying February is the first window of downside vulnerability for the markets in a long time. And I raised 20% cash and collared some stocks using options.
Okay. Let's see. I think that's pretty much the main stuff from the chat room. You said you had some questions too, Tom?
Oh, yeah, we could go for a while here.
Yeah, let's do it.
Well, first, I love this Caddyshack reference because I'm a golfer and I love that movie. It was one of my favorite movies, so I thought that was pretty cool with Ty. Anyway, I won't go into that. But do you approach, there's a lot said about go away in May. Of course, we just started May. I'm not a big proponent of that. And I've, published a lot of reasons why. But there is, in my opinion, that the summertime, you do get that slowdown. I've kind of highlighted maybe mid-July to the end of September. That period
didn't happen last year.
No, it didn't. No, it didn't last year. And historically, though, I mean, if you go, and I go back 1950 on the S&P 500 in my data, and that tends to be, if we're going to have a weak period, that tends to be when it is. It doesn't happen every year. But I guess my question is, do you approach the market differently at any point during the year?
No, I rely on my models and indicators. We have a proprietary way to measure the stock market's internal energy. Regrettably, that model doesn't tell you which way the energy is going to be released, but it tells you there's plenty of energy built up inside the market. If a move starts or commences, that there's enough internal energy to make the move decent. So I am never totally out of the market. With the Dow theory sell signal in September of 99, I raised 40% cash. I did the same thing with the Dow theory sell signal in November of 07. And for stocks I wasn't going to sell, like Raymond James stock, I sold the out-of-the-money calls, long dated, and used the premium I took in from that to buy the closer in at-the-money puts. And the stock went from 37 to 11, and I didn't lose any money.
Mm-hmm. Yeah, smart.
Yes.
Absolutely. How about, when you look at the different asset classes, now you said earlier that you kind of agree that you think interest rates are going up, although you don't think they're going up that fast. Is that changing your asset allocation from bonds to equities in any way?
I have no fixed income investment. I saw the bear market in fixed income in the 70s and 80s, and it was brutal, absolutely brutal. I'm in your camp. I do not like the consumer staples. I think I've been telling people that for 18 months. They're cheaper now than they were 18 months ago. But I mean, you had companies like Clorox trading at 30 times earnings, and the CFO of the company will tell you, we're only going to grow by 3 or 4% a year.
Mm-hmm. Yeah, that doesn't make any sense at all. What's the main reason? I mean, obviously valuations are a problem, but most bull markets, you're going to get wide participation. That's one thing that's kind of characteristic of a bull market. You see all areas going up. It's just that certain areas go up a lot faster. XLP, I mean, consumer staples, they topped in January with the overall market, but they're still down near their lows for the last 3 or 4 months, while many areas of the market are either at their highs, some areas even breaking out. What do you think there? Is it just overvaluation, or is there something else going on?
Well, I think they got bid up to extraordinarily high historic valuation levels because a lot of professional money managers did not believe that we're still in a secular bull market, and yet they had to put money to work, and so they put money to work in the defensive names, which is what gave them the high valuation metrics. I like just about all of the macro sectors except consumer staples, and I'm not real wild about utilities.
Mm-hmm. Okay, makes sense. I'm going to pull up a chart here, if you don't mind. So I'm going to go ahead and take the screen. I want you just to comment, because you mentioned commodities. You were talking about commodities earlier, and here is the CRB index, which has shown a beautiful breakout. While the overall market has been moving lower and consolidating, especially on the S&P 500 on the Dow, we got the CRB that's broken out to a new high in April. We're just retesting it now. Really been performing well here, but we also talked about a dollar that's been rising. And I know, you got that inverse correlation with the dollar and gold. But my belief is that the dollar, while it does present some headwinds for commodities, it's not like all commodities go down when the dollar goes up. And one in particular, I think, is energy. I mean, crude oil prices are subject to global economic demand and supply. And if global economies are starting to pick up, we're getting more and more demand. We see crude oil prices go up. And I've done charts before where I show the positive correlation between the direction of crude oil prices and the direction of not only the U.S. market, but world markets. They tend to go up together, because if you got stronger demand for crude oil, it probably means you've got strengthening economies and higher company prices around the world as well. So I guess, having said all of that, my question is, with the dollar rising, are you concerned at all about commodities as we go forward?
I showed a ratio chart that showed commodities versus equities are the cheapest it's been since the 1960s. So I have tilted portfolios, as I said, into midstream master limited partnerships that don't have a lot of price sensitivity to crude oil. You can think of them as transportation companies without wheels. They own the pipes and the storage, and they have long-term contracts with people like Chevron and Exxon. Archer Daniels Midland and companies like that. But in terms of, I'm not in the gold camp, so I agree with you there.
Okay, well, the reason I was interested because commodities, the CRB index has started to turn up, and a lot of that, of course, is because of energy and crude oil prices moving up the way they have. But on this long-term chart, you can see, and this is kind of, I guess, this validates your point. CRB relative to the S&P 500. I mean, this has been a ski slope now throughout most of this bull market. And that's because, most of the time you've got a, declining dollar. But really, when I go back to that other chart that I had up earlier, the technical, this chart here, I mean, what we've been seeing is rates in the U.S. moving up much faster. And as a result, much faster than Germany. And as a result, really, we've been seeing a rising dollar. Even though we struggled in 2017 and 2018, I believe we're still in a longer-term uptrend in the dollar. And so that's been a little bit different for this bull market relative to the last one, or the last couple. And so, in my opinion, I think the dollar goes higher. And I think commodities and the CRB can actually move up with it at this point. I'm guessing that you agree with that based on your valuation and what you talked about earlier.
Yeah, I absolutely agree with that. And I'll tell you, I travel all over the world talking to portfolio managers, and a stronger U.S. dollar gives them much more incentive to invest in U.S. stocks, because not only do they benefit from the rising stock market, they also benefit from the rising U.S. dollar.
Would you overweight small caps as a result? And based on what I was showing earlier with the small caps rising, is that something, or do you not get involved in the small caps?
I do like small caps and mid caps. In fact, Raymond James, in terms of the Greenwich studies, is one of the best research shops for small and mid cap companies in this country. So we have about 1,300 universe of research stocks here at Raymond James, plus research universe. We've got 18 analysts up in Canada.
Okay. I got a final question before we bring up our poll and talk about that for a minute. Final question is, are there industry groups? Is there a theme as you go? We've been in this sideways consolidation for the last 3 months. You've come across being very bullish. You believe we're continuing into secular bull market. We're going to rise, into later 2018, 2019, so forth, maybe for the next few years. Is there a theme industry-wise, or is there something that really has caught your attention where you believe this is where you need to have some of your money?
Well, if you pull up a chart of the XLK, you can see that's broken out. Mm-hmm. So I think technology. I'm probably, well, that's not true. I'm most overweighted in Raymond James stock, but I think tech is a great place to be.
Okay, even with the many years of outperformance, you think that continues, and that XLK you would still, I don't know if recommend is the right word, but you still feel good about technology going forward.
I like companies that do things better, faster, and for the end user. And, that's companies like Amazon. That's companies like Facebook.
Yeah, Facebook, even with the scare they had recently with the compromised security and all, you still like Facebook at this point?
I do.
Okay. Yeah, technically a nice move here, breaking out above this gap resistance. That I think this is when that news broke on that.
Yep, that's exactly what it did.
Big selling there. It is coming back, no doubt. Volume's shrinking, little nervous, but it's got another level up around 185, 186 to negotiate.
Joe Granville, in his Sentinel book, wrote, "Negative volume up is very bullish."
Yeah, I think at times it certainly can be. I know that there are a lot of folks that have looked at the market when the market sells off and we get big volume and then we start to rally back. My experience is it's always lighter on the move back up.
Yep.
Because no one panics to buy. Everyone panics to sell. No one panics to buy.
Well, you can tell from the sound of the New York Stock Exchange, if you're down on the floor, whether people are selling or buying. There's two totally different sounds in people's voices.
I can imagine which one's which.
Yeah, those sounds can be heard from my home office now and then.
There you go.
Yeah. All right. Well, I'd like to pull up, maybe if we can, the poll that we had for today, because we did talk a little bit about commodities briefly and energy prices and so forth. And we've had this big move to the upside in energy. So I thought we'd run this poll, because we are trading at a multi-year high now. Where does our audience believe crude oil prices will be a year from now? 56% saying higher, 37% lower, and 8% saying unchanged. Which camp would you be in, Jeff?
I think they're going to be higher. Obviously, professional investors think that the supply is going to come on and that the stocks will go back down, which is why the valuation metrics haven't kept up with the rally in crude oil prices. But my dad used to tell me, he said, "Son, good things tend to happen to cheap stocks, and the energy complex is cheap."
Mm-hmm. Has been for quite a while.
Yep.
No doubt about it. Well, it's certainly been a pleasure having you on here. This was your first trip on. I hope you'll come back and join us sometime.
Sure.
It's been a pleasure, and I'm sure our audience has really enjoyed it. We like to bring folks in a lot of different perspectives, some bearish, some bullish. I would certainly say I'm kind of in the camp with you. I do think that this is a secular bull market. I think that this, another year from now, the 3 months that we've been through, the last 3 months, will be in the rearview mirror. But that's just my opinion.
I agree.
Okay, and there he goes again. Thanks to Jeff for coming by and sharing his wisdom, experience with us. Certainly a very good presentation. Really enjoyed hearing his thoughts on that. And
Absolutely.
I guess now it's time for 10 and 10.
Absolutely is. Let's see. I've been watching the chat room, and and Jeff's presentation so much, I never got around to putting them all in. So I'm not going to be able to show you the RRG, but we have about 38. So patience, everybody. Be sure and get your likes in, because the second symbol we give Tom will be the most popular from the chat room. So go ahead and hit that. And I think WFC is our first one. And what's funny is we actually had 2 people request it today in the chat room.
Oh, okay. Well, I got to say first, as I mentioned earlier, I like banks because I think that yields are going to go higher. I think we're consolidating, but we remain in an uptrend. And I think banks are going to do a lot like the XLE did with crude oil. Crude oil prices went up and XLE just kind of languished for a while. And then all of a sudden, the XLE took off. I think maybe we could be getting some of that right now in the banks. Now, do I think WFC is the best bank? I'm going to say no, and I'm going to bring up a relative chart that I like to use, and we'll go ahead and annotate that using this relative chart. But what you see here is a bank group that made a big move. I think is consolidating with the overall market, but starting to turn back up. But look at Wells Fargo relative to its peers in the banking space. I don't like a bank within the space that is not performing, that's lagging. I want to get stocks that are actually outperforming its peers and the industry group itself is outperforming the S&P 500. So that, in a nutshell, is why I would not get into WFC. I do think it's in a good group going forward. I would look for banks to do well in the balance of 2018. But I just think that you'll probably find some other banks that look better. Now, as far as what level to watch here in the near term, I think we had that initial thrust to the downside on very heavy volume in February. We bounced, failed to get through that 20-day moving average, kept moving lower. I believe actually printed a positive divergence on this low, and now we're breaking back up above the 50. But I still see some key price resistance at 55 to try to get through. If we can get through that level, then I think watch the relative strength. As long as we continue with the relative strength moving higher, I think you're okay with WFC. But if you see that start to turn lower and not performing as well as the peers, I would be looking for something else. But 55 is the key level I'd look for.
All right. And drum roll, the most requested symbol in the chat room is Walmart, WMT.
Okay, WMT. Well, here's that breakdown. And I think 80 is what we were talking about if it broke down out of this consolidation. Very heavy volume, but we haven't quite gotten to that 80 level. You can see the broadline retailers have been doing extremely well, but this is another case of a stock that is just not keeping up with its peers, and as a result, not outperforming, in fact, badly lagging the S&P 500. So we're getting another breakdown. However, I do think Walmart's a great company, and I think as you get closer to a major support level, I would begin to get a little bit more interested. I think you have this whole gap support zone where we had the huge gap up in October, between 80 and maybe 81.5 or so. As we get into that area, I would expect to see buyers emerge for Walmart.
Okay. Let's see the next one, our only consumer staples request, Coke, C-O-K-E, Coca-Cola, of course.
Yeah. Well, another breakdown, and kind of gets back to what Jeff was talking about. I mean, a lot of these consumer staple stocks are just out of favor. And we can sit there and hope that they become in favor. But you can see the group itself is weak. Coke has actually been one of the better performers, but when you're in a weak space, it's really hard to get going. So Coke has been faltering for quite a while. First step is it's going to have to get through that 20-day moving average before I would even consider it. So let me mark that in here. You can see the failure there, and that is declining. And the recent price support, which was lost, was at about 41.5. And you can see some pretty good volume here on this move to the downside. So I wouldn't consider Coke until, number one, I get back through resistance and that 20-day moving average. And when I get through both of those, then I would like to look to see if the group itself is starting to perform better. So then I might get behind it. But right now, I would avoid. I think there are so many other stocks that look better.
Oh, let's see. Okay. Semiconductor, Applied Materials. It was also popular in the chat room today.
Yeah, many of the semis have really struggled. Applied Materials coming off of its recent low, which I think is good, but you can see sideways consolidation here for the last several months. Let's pull up a weekly chart and see what's going on here. I'm okay, I think, with Applied Materials as long as it holds around $47. So from a longer term perspective, we got a nice uptrend that's in play. There's where we had a double top breakout. That would have been in September. Look at the volume come in on that spike. Went back down, tested that area, went to a new high. We don't want to lose this low. So I would say $46.5, $47 would be a pretty critical area of support on Applied Materials. As long as that is not violated, I would expect a test of the price resistance up near 62, 62 and a half. And eventually, I think we're actually going to go higher. One of the things that Applied Materials is doing right now is just, it was very overbought, along with many of the semiconductors, made just a huge advance. And I think sideways consolidating, which is not a particularly bearish thing. It's actually pretty bullish. So I think eventually we're going to get that breakout to the upside rather than the breakdown. But you probably need some patience here.
Okay. Let's see, next one, Johnson & Johnson, J&J.
All right, J&J. Another one that's kind of more of a defensive stock, and you can see these are the stocks that are just not doing well. And again, on a relative basis, they should be doing much better if the market truly was going to be heading lower. So I find this to be a good sign for the overall market, although you'd like to see Johnson & Johnson participate at least. But like Coke, it failed to hold on to a recent low, and its move in early May to the downside, breaking that prior support, was on at least average volume, if not maybe a little above average volume. So that's a little concerning. And once again, I think I would have to keep an eye on that declining 20-day moving average. If we could get back up through 126 and get some volume on that move to the upside, I'd start to be a little bit more bullish on Johnson & Johnson. But for now, it's just, an avoid.
All righty, let's see. The next one, let's see. It's in the special consumer services industry. We've never looked at this. MELI, Mercado Libre.
Yeah, and I think they may report earnings tonight. I don't think they reported this morning. I think they report tonight. So you want to be careful with that. I would just say you've got not a great looking chart here. We have been pulling back, trying to hold on to the support level around 320. So let me annotate that. That would be the area that I would watch pretty closely. You also have this gap support. I'm going to say this is the area that you really want to hold on this stock going forward. Here was the gap up with very heavy volume. We've pulled back on a few occasions and tested this 310, 320 range, but we haven't lost it. I think with the PPO down in negative territory, I think if we were to gap down with earnings and lose that area of support, that would be bearish for the stock. So again, I don't like to hold into earnings, so I would avoid it. But that's what I would be watching for after earnings, make sure that level holds.
All right. Let's see, for our shout out for our Canadian friends, ATH.TO. This is an oil and gas producer.
Okay. Well, doing about as well as I would expect. I mean, a huge move to the upside. It's been a doubling here in about the last 7 weeks. So this is quite a move to the upside. Very heavy volume, though. So being supported, being accumulated, no doubt. So far, these pullbacks, anything close to that rising 20-day moving average has been, once you get this uptrend started, and notice I talk about this all the time. When you're in this sideways mode, see how many times we go up and above the 20-day and the 50-day and then come right back down? These are trend following. These moving averages should be used for trends. And when you don't have a trend, they don't really help. So if you're looking at the 50-day or 20-day in here, I think you're just wasting your time. When they start to become more important, though, is when you're trending. And since we have broken out in mid-March, anytime we've gotten close to the 20-day moving average, I'd be looking for actual test. But every time we've gotten close, we've turned back to the upside. So from a trend following perspective, as long as we hold that, I would be okay. Now, buying at this level makes it really risky. Jeff was just talking about managing risk earlier and how important that is. And I think from a trading perspective, there's really not a whole lot more important than managing your risk. If you get in at 190 and you're saying it's safe or it's okay as long as it holds the 120 or the 20-day moving average, you're saying essentially that you're willing to lose 30 cents on this stock before it gets to a key support level. That's unacceptable for me. That's more than 15%. So I can't buy this stock at 190. Now, if it got back down into, say, the 165, 170 range, however, it would start to look a lot better because you've got gap support there, and this rising 20-day is going to continue to climb. So if we were to get a pullback like we did yesterday to that gap support level, I think it would start to look a little bit more bullish, or a little bit better from a reward to risk standpoint. I like the stock. I just think you have to be careful on entry.
All right, let's see. Let's see, we were talking a lot of oil, so I'm going to go ahead, and it was requested as well. RIG, R-I-G, from Oil Equipment and Services.
Yep, another big breakout today and very strong volume. So you got to like that. I know some will look and say, well, you got a negative divergence. Well, you got a negative divergence a lot of times when you first make a breakout. We're just starting to turn up. We don't know how far this move is going to go. We don't know how far the PPO is going to go on this move. So I think until you get a reversing candle, I wouldn't be worried about a negative divergence. Instead, and again, when you're looking at negative divergence, you're thinking momentum is slowing. Well, it's kind of hard to argue momentum is slowing when you're going to have the heaviest volume day, or one of the heaviest volume days of the last 6 months, on a breakout with the stock up almost 8%. That is not slowing momentum in my view. So I think you got a great breakout here, very bullish. I like the stock, but again, with it up 8% today, here is your price support level on a pullback. I'd like it more if we got closer to 1275, 1265, something like that. But I think RIG looks great.
All right. From materials sector, tech resources, TECK.
Okay, well, we've been moving lower, a lot of volume here, but we held support, so I'm not worried so much about that volume as long as that support continues to hold. So I would just draw a line there. I think that is your key area to watch closely. In the meantime, moves back up above. You can see many tests around the 27.5 area. So I think we're in this trading range, 24.5 to 27.5 for now. We're sitting almost in the middle of it, 26 and change. So I don't see a trade here. But as you get closer, what I really would like to see is maybe an intraday move below the support level, coming back up and holding it. That to me would maybe give me some more confidence for a long trade. Or I'd wait until we got a breakout above 27.5 with some increasing volume.
All right. And let's see, we're on our final one. Let's go, and we haven't looked at the financial space. How about BEN, B-E-N, Franklin Resources?
Okay, well, we've got the downtrend clearly in play. You know, it's kind of hard. Actually, I'm going to pull this one up in the relative chart view, just see what its peers are doing. This is the Asset Managers Group, DJUSAG. Yeah, I mean, we've been pulling back, and I would expect movement to the upside, and we see that the asset managers are starting to rise, but BEN is actually pulling back. And look at the relative strength here. So if you're looking at asset managers, you think, okay, I like financials, I like asset managers. This is probably not going to be the one that I would pick out of this group. I mean, it's breaking now to a new low relative to its peers, relative to the S&P 500. And to be quite honest, last few months, this hasn't been a great group to be in during this consolidation. I think that's going to change, but for now, it hasn't been. I would just say, you know, annotating this one. And again, the problem I have with a stock like this is that you've got many other stocks within the space that I think are going to look a lot better, because not only are we moving lower here, but this relative strength is, to me, just not pretty. If you can't beat your peers and you can't beat the S&P 500, I have problems understanding why I want to get involved. So if I was looking for entry here, I'd keep looking.
All right, and that is 10. And I think we actually did it in about 10 minutes. So congratulations.
Maybe 12, but it was good. Close enough.
Yeah, before we move on to a market update, I did want to tell everybody. So you, in fact, I'm going to share my screen right now so that they can see. But here's the 10 and 10 symbols. We'll first look at those. And all of those will be up in the Market Watchers live chart list. And that's what I want to show you before we move on, where you'll find it. All right, so if we go to the blogs, and I'll show you why I'm going to show this, and you go to the Market Watchers live blog, there's the live chart list. And today, you know, we had Tom, he did a relative chart. Well, you'll notice the first chart here is a price relative chart. And all of you are always asking for the settings for this. If you just click on that chart, it comes up in your workbench, and then you can look at what the setup is, and you can just set up a new chart style for it. And then you can always do this relative chart for any of the stocks that you want to look at. So I just wanted to remind people, if you're in somebody's blog, if you're, I think, I know Decision Point has a live chart list, or you're in a blog and you see a chart you like or you want, just click on it and it's going to bring it up into your workbench. And so you can manipulate it, save it, however you want to do it. So just wanted to remind everybody that, because we do get that question all the time in the surveys and a lot of times in the chat room. So I just wanted to make sure everybody knew how to get there, because they love your chart style, Tom.
Well, it is kind of interesting. I mean, it does give you a lot of information about a stock on one page, not just how it's performing, and that's important. But if you've got a group that it's in that's absolutely, flying, and you've got a stock in that space that's simply going along for the ride with the S&P 500, then you probably don't have the best stock in that area. So it's always good. And just about everybody we've had on the show has talked about relative strength and how important that is to be aware of, what's leading the market, what's not, how your stock's performing relative to other areas, and so forth. So I think it's an interesting chart that you should keep at least to refer to once in a while. See how, just keep tabs and check out the report card, if you will, on your
Yeah, and you can have quite a few. And I like to make buttons for my different chart styles. This is the Market Watchers account. So I have Tom's set up, and of course your relative charts in there, and Decision Point set up. So it's so handy, so handy. So I just really wanted to impart that, because again, we get a lot of questions. So, all right, ChartCon is coming up, and let's see, you can find that link at stockcharts.com/ChartCon, and it is it's 3 months away. Let's see, today's the 9th. So I know we'll be flying out there, well, 3 months. In 3 months, I can't believe it. We'll be on our way. So we can't wait. I know you can't wait, Tom, but we have an excellent theme this year, reducing risk in uncharted waters, and recommend that you go and register. You can check out the speakers right here, who we're going to have. And I mean, it's quite the lineup. And if you want to see the agenda as well, just remember, this is an online conference, so everybody can go who has a device, computer, and if you're watching this show, you certainly can go to ChartCon. So recommend you check it out. And with that, I'm going to go ahead and move into our final market update. All righty. And away we go. I'm going to go right over here to the candle glance. I just want to, again, I like to go to these so you can see how to get to them. And there we are. So our candle glance, I'm going to adjust it. Sorry, Wilshire, 5,000. I'm going to get rid of you for the TSX. And let's see, we've been talking about energy again. So I'll put XLE in there. Why not? And there we go. So I get all of these on the one page. These are 2 days. I believe they're 1 minute charts or 10-minute bar charts. So anyway, what I wanted to note is since we've been talking, Tom, I mean, the market started to take right off. It looked like we were going to consolidate. And within like the last hour, we're just starting to really take off, setting new intraday highs currently on the Dow, S&P, and NASDAQ, as well as the Russell 2000, seeing some really nice action right now. TSX not following suit just yet, but there's still some trading days left, or trading time left, so we'll have to see. And we've got Treasury yields, as we were remarking earlier, up currently at 3% at this point in time. UUP is pretty much unchanged, down only a cent. We could see gold, though, is moving lower. A bit further down, we're getting a reading of 124.40 for GLD. Also, I'm looking at this intraday charts here, and I see a double top forming here off of a a rally. So in the very, very short term, I would expect to see gold travel lower. I've been saying that in the short to intermediate term as well. USO gapped up and is now rising gently higher. We can see that XLE, like we were saying, this is an area of the market that's starting to really take off. And you can see with today's action with the gap up early, we're not quite at the intraday highs, but certainly rising and doing quite well. And with that, I'm going to conclude our final market update, and we can go ahead and move right into technical scans. Or did you have something you wanted to add, Tom?
Well, I was just going to say that the crude oil prices are up almost 3% today. We're up over $2 and now trading above $71 a barrel. So that's one of the reasons why you're seeing that XLE perform as well as it is today, leading the market to the upside. And then, of course, small caps with the move that it's making today. We've got small caps now within 1% of its all-time high. So not far from a breakout. And again, that rising dollar is not hurting small caps, that's for sure.
Absolutely. And let's see. Yeah, I know you've been, pat yourself on the back here, Tom. I mean, you've been talking about small caps being the place to be going into May and watching what's going on with the rising commodity price, rising dollar. So I pat yourself on the back. That was a good call.
Well, every once in a while I can make one.
Yeah. All right. So with technical scans, do you want to start off, or would you like me to start off?
Go ahead.
All right, I have this here. I'm going to want to cover two things today when we're on our scans. One, I have a scan for dogs, and that's not to go get one from the pet shop. That's to find those that aren't doing well. And, I'm not going to go through and look for shorting opportunities right now, especially on a nice breakout day like we're seeing. But one of the things I do is I will run both of these scans, the one that's my bull scan and the dog scan. And I like to compare how many results I get. So I'm going to just check this out right now. So how many bullish results am I getting right now on my PMO scan? Currently 23. So let's go back. I'm curious, how many do we have for the dogs scan for dogs? Here we go. Oops. Definitely don't want to do that. Pushing the wrong buttons here. Okay, so let's go ahead and look at the scan for dogs. And we only have 2. So that right away gives me a sense of what's going on in the market in general, just knowing that we're certainly seeing, just based on the scans, I'm seeing more opportunity clearly in the buying areas. So what I want to do is I'm going to go through one of my scans, and I'm going to go through the general PMO scan, because that's what I just ran earlier. And I want to explain what it's doing before I go and run it, because I think that's important. And this particular scan, you can find the link to my this PMO scan, I think in particular, at the bottom of every Market Watchers blog entry. Every blog article at the very bottom is a link to my article on my PMO scan. So you can just quickly copy and paste it into the scanning workbench. So first of all, I got to narrow down my universe. I like to go with, U.S. stocks. I want a certain amount of volume, and it's a stock, not necessarily an ETF. And I want to get rid of penny stocks. So I want to close above $10. Then what I do is I look for a PMO, price momentum oscillator. It's similar to the PPO. It's a momentum oscillator, right? So I want to see it not having that buy signal yet, not yet having the positive crossover, but I want it to have been rising for 3 days. So it was something that wasn't doing so well as far as momentum, and now momentum is starting to pick up. But I'd only want to look at stocks that are sort of set up in a bear market or a bull market configuration. So I want my EMAs to be situated with the fastest on top and the slowest on the bottom. And then finally, I like to find with scooters that are greater than 75. I want to find some stocks that are already, have a good batting average, that are already strong in the intermediate term. That's kind of my time horizon when I generally invest. So that's the scan that we're going to run right now. And those are remember the 23 entries. You need to store them if you want to do anything with them. And I have a chart list that's just, well, as it says, scan dump. I dump my scan results here, and then I'll go in and save them to the list that I want. So first of all, I want to look at what sectors are coming up on this scan because I'm very curious. And notice that it looks like it's predominantly, we are getting predominantly healthcare stocks, and it looks like some technology as well on the higher side. So I might be more interested in looking in those just because clearly those two sectors are they're looking pretty good. But then I like to go to my candle glance, and you'll notice it's not the same one maybe that you get. It's a custom style. And all it is I went to my workbench and I set up a chart style called Candle Glance. Name it exactly that, name it Candle Glance, set it up the way you want, and now that's what you're going to get as far as your results. They will come in on the Candle Glance the way you want them, and so that's why it's listed that way. But let's get back to our results. So what I do after I run my scan, and I've shown, I might actually do a workshop on this, but if I haven't already, I can't remember, but you guys can certainly vote and let me know. But one of the things I would like to show you, and I'm not going to get too far into it because I want Tom to have some time, but scanning and sifting through the results. You know, it's great when you get the scan, but then what the heck do you do with all of these results? Well, that's why I have my PMO on here and the 20 and 50-day EMAs, because those are the two important ones to me. And so I want to look for either chart patterns. I want to see some nice PMO setups. One thing I look for are clean crossovers. You don't get a lot of them, so you know you're not. You don't get head fakes that much. I want to look for possibly breakouts, or you know, this one looks pretty nice. We were heading into a downtrend, and now we've formed a double bottom. So that one could be very interesting. Plus, you can see the PMO is turning up above the zero line. And I do like to look at PMOs that are oversold, which of course would mean they're negative. But when they're oscillating above the zero line, that tells me something. That tells me they have internal strength. So anyway, let's see. So let's go ahead and look at that one. Like I said, it caught my eye right off. So I might as well look at that for you. So there's that double bottom. I'm going to just annotate this particular one. And then I'll pass it back to you, Tom, for some interesting scans as well. So I'm marking the double bottom. I'm going to mark my overhead resistance. I like to make mine fat and a little bit opaque so that I can see through and catch maybe zones more than just actual bottoms like that. So I like to get that in there. So this is clear support zone, bounced off of it. 20 never dipped below that 50-day EMA. It's starting to turn up. PMO is starting to turn up again above the zero line. Look at the OBV, rising bottoms in conjunction with rising bottoms on price. So that's a bullish confirmation. Again, nice strong scooter. So we know, you know, it's in the zone. It's got a good batting average. That's how I like to look at it. It's doing well. And of course, you know, scooters can be way up there, and then, you know, a bad day is not going to drag it all the way down. So I think it's a really good indicator that way. So anyway, I like this because I still, you know, I'm in a trading zone here, worst case, and I'm in the middle of it, but looking at the pattern, looking at the PMO, I would be looking for that breakout on Alteryx. So that's just a quickie on my technical scans and kind of how I run those. I think someone also suggested maybe, you know, a checklist or my trading plan, how I, you know, go through my day. That was one I think I've seen on the survey for my next workshop. Go ahead and please fill out that survey and put your ideas in there, because it does help a lot in us forming what will be interesting to you.
Okay.
And there we go.
All right. Let me go ahead and pull my screen up. Okay, I have a scan that's ready to go. This is what I refer to as my high volume scan. Some of you may have already seen it before. But essentially what this is it's just looking at all U.S. stocks, and it's looking at liquid stocks. So I want to make sure that the simple moving average over the last 90 days, that we average at least 300,000 shares. I just want to, you could probably lower that to 200, maybe even some of you 100,000. But I want to make sure that the average is at least 300,000. I like to make sure my stocks are very liquid. And then I want to make sure that basically the average price of the stock over the last 90 days is greater than 1. I'm not interested in penny stocks. Again, some of you may change that if you're interested in lower, or maybe you might even want to up it to $5 or $10. Some of you may be more comfortable trading stocks that have higher prices. And then finally, and this is the biggie, the daily volume is greater than its average daily volume over the last 90 days by 3 times. Now, I like to run this scan early in the morning, like in the first 20 or 30 minutes, to see where the money's going really early in the day and maybe try and catch something on a breakout. So I normally have this set at like 0.4, which tells me if a stock in the first 30 minutes of trading has already traded 40% of its average volume, then that means something's going on, probably either technically or maybe there was fundamental news coming out. Something is going on there. So, but because it's later in the day, I mean, we're talking about, only 2.5 hours to the close. I used 3 times, and I'd already kind of been playing around with this just to make sure I could get a reasonable number of stocks in a sample. But if I use this, always when you have any kind of a scan, check the syntax, everything's fine. Then I run the scan. And once I run this scan and it comes through, here's my results. I got 34 of them. So looking at all U.S. stocks, I've got 34 stocks that right now normally trade at least 300,000 shares a day over the last 90 days. And their volume today is at least 3 times normal volume. So this doesn't mean I'm getting all the highest volume stocks in the market. I'm getting all of the highest relative to their average. So it's a big difference. This isn't going to give you all the stocks that trade a lot of shares. Some of these stocks may only average, 400,000 shares, but they're doing 1.5 million today. So hopefully you can kind of follow with that. And then what I do is I normally will drop them into an existing chart list, which I have a high volume scan results folder, and then I drop them in. Now, the way I go at it from here could depend on what I'm looking for. For instance, you've got this show hide columns, and the U here is the market cap. So if I add that, which I just did, you can see now I could sort this by small cap, because I might be interested in small caps with what's going on with the dollar right now. And you can see some of these stocks have just absolutely gone crazy. I could sort it by scooter ranking, so you can see which stocks have really done well. I know this has been on my strong earnings chart list, and I think they just came out with earnings again, a smaller defense stock. And look at the response here on Axon Enterprise. Huge move up with earnings. Some of these stocks, if you hold into earnings, you'll do very well. Others, we could probably find a bunch of them that are on the other end of the spectrum. It's just whether or not you're willing to take that kind of risk. Because to me, it's like running or, spinning the roulette wheel in Vegas.
Yeah, well, we did have that comment earlier today about somebody who said, thank you, Tom, for telling me not to hold into earnings, because they didn't. They sold. And then after earnings, the stock was down more than 25%.
I think that was CUTR.
Yes.
There it is. Yeah, here's the flip side. CUTR, Qterra, down 28% after reporting earnings. And honestly, when you look at the chart, there's really nothing.
Pretty good, yeah.
Yeah, I mean, technically, you wouldn't know anything was bad about it. But I tell you what, my experience, when you've got a good chart that looks good technically, it tells me that the problems that they reported, they didn't share with analysts.
Clearly.
So we had a lot of folks thinking we were going to get a good report, and then we got a bad one. And this is the kind of stock I would ignore for a long time. I think the same thing happened to Snap. I think Snap, even though Snap had been downtrending, after its last report, it had such a huge move. And I'm going to get back to my scan here one second. But Snap had this huge move, and no one came out with any warning. I mean, we just continued moved lower and lower over the next 3 months, and then they dropped a bomb with their quarterly results. And it's no huge surprise that their CFO is no longer with Snap. That I think they announced yesterday that they were replacing their CFO. So, that's one thing you got to be careful about on Wall Street, that Wall Street doesn't like to be, I don't want to say lied to, but maybe misinformed about what's going on. And it's a trust factor. And so once you come through with a report that, really shames a lot of analysts, it's not easy to build that trust back. And so stocks that come up way short are stocks that personally I would avoid for quite some time. Normally they have problems getting back on track. But anyway, let's go back to that scan. You can see a lot of different things. There was one stock on here. I'm going to see if I can find it. I forget which one it was now. It was a really nice looking chart, and I wanted to bring it up because it had pulled back.
Maybe you can see it on Candle Glance.
No, actually, it was on the percentages. Yeah, I could probably do it on Candle Glance. It was one of these stocks in here. MVIS, I think, might have been it. Yeah, this is it. Okay, remember I was talking earlier about a stock gets, just going crazy, moving up, and you have this huge distance between the price and the 20-day moving average, and how when you get a nice PPO rising, good volume, you get a breakout, you want to just chase, but chasing is normally not a good idea. This is a perfect example of a stock that 5 or 6 days after trading well above its 20-day moving average came back down and tested the 20-day, allowing a much better reward to risk entry. Now, I don't know if this is earnings related. If it is, I wouldn't have been in anyway. But if it's not, you can see that waiting and pulling back, getting in at 125 or 127 instead of chasing it at 140 or 145 makes a big difference in your return. So I just wanted to point that out. I know we're running a little bit late on, or short on time, so let's go ahead and start to wrap up. We can go with a quick, recap of our technical scans, but just showed you a couple of different scans that we use to try to identify some candidates based on each of our personal trading style and strategy.
Exactly. I know I couldn't trade without the scans. I really couldn't. I used to do it off spreadsheets at decisionpoint.com, and very tedious, but it worked so well to find them. So when I finally was able to do a scan like this, great. It was great.
Yep. And I tell you, it was really interesting having Jeff Saut on the show today. I meant to ask him because I think he told us before the show that he's going to be going on CNBC. And I don't recall if that was today or if it's later this week. I'm not really sure. But anyway, it was really good having him on and having his perspective. He's been in the market managing money for many, many years. So it's not like somebody who just comes in and tell you what they feel. I mean, this is somebody who has to put a lot of money to work.
Absolutely.
So I tend to give a little.
Well, and the fact he flies all over the country to tell everybody, what he's looking at, I think good stuff. It was excellent having him here.
Absolutely. So what do we got coming up?
Yeah, I was going to say this week is not over yet. We have Dan Russo from Chaikin Analytics who will be joining us tomorrow. And then on Friday, we have Everything Stock Charts. Finally, on Tuesday of next week, I'm going to be doing my workshop. I am still taking requests on what subject you'd like me to cover. You can let me know that by taking that survey that is under the viewing window from the Stock Charts TV tab.
Sounds good. We would like to thank all of you for being with us today. Please remember to complete that survey as you exit. We'd like to know what you thought of Jeff's presentation. And also, we'd love to get your feedback, what you think of Market Watchers Live. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. Hopefully, we'll see you back here tomorrow on Thursday. Happy trading.
Here's how to put a simple line on your chart without using the annotation tool. Let's say we want a line in here at 47.50. You can just drop down here into the overlays, pick horizontal line, add the price point, 47.5, and we're going to use a red line. We're going to make it solid and thick and hit update. and that blasts it into the middle of your chart.